Welcome to the MHP Exchange podcast, where industry veterans Frank Rizzo and Eric Busadil generously share their wealth of knowledge in their new podcast dedicated to the manufactured housing space. They tackle tough questions to provide valuable insights for those considering investments in mobile home parks. If you're seeking answers in the manufactured housing space, this podcast is your go-to resource.
Welcome back to the MHP Exchange podcast. How are you this morning, Eric?
Good, Frank. How are you today?
Doing very well. Doing very well. And for those of you listening today, we're going to have a program that affects a lot of people who are investing in real estate. And, you know, in our program, what we look to do on the MHP Exchange is talk about how, not just how mobile home park investing could bring you towards the path towards financial freedom, but how real estate investing can really sets that pathway for you. And one of the challenges in speaking with people that they have is in how to structure their real estate investments as a business. And I think that's one of the challenges from my 20 years of speaking with, individual investors, having their own, whether it's a W-2 job or having their own business, fitting their real estate business or investment business alongside of that sometimes is very challenging and overwhelming. I mean, I'm sure you've seen a number of people who've probably succumbed to the fact that they just said, I can't do this anymore, right? They've thrown up their hands and said, this isn't for me.
I think when you get to a certain size, it becomes very difficult to, it just becomes very difficult to manage, and it becomes a second job.
And that's correct. It becomes a job, not a business. And our guest today, he has proven that you could run a successful business alongside a very successful business. His name is Joseph Biondolillo. He's the founder of BiondFinancial. He's a financial advisor. And we're here to talk to Joe today really about how he's been able to successfully build a business alongside of, a practice that's really his main focus, and really create another stream of wealth and cash flow for himself that's put him really at a different level. So with that, I want to welcome Joe to the program. Joe, how are you this morning?
Doing well. Thanks, Frank. Good morning, Eric. Thanks for having me, guys.
Morning, Joe.
Joe, before we even get involved a little bit deeper into what you do, I mean, do you want to share with everybody a little bit about your background and how kind of real estate fits in alongside of what you do?
Sure. So where I am today is not where I started. When I started my career back in 1998, I began a career on Wall Street. And when I worked on Wall Street, although I was enamored by it when I first started, I quickly realized that that was not a business my intentions were to be in forever. So in building my firm on Wall Street, I always was mindful of creating alternative income streams, which alternatively would wind up being my transition out of that business in the future. Now, my Wall Street firm changed into the company I have today, which is BiondFinancial, where we focus on comprehensive financial strategies for entrepreneurs and successful individuals. But the entire time I started building that real estate business 20-something years ago, we've continued to build momentum, and it's been an active part of our business model.
So, and not to say how many doors, but how many units or how many doors do you have currently in your real estate portfolio?
Listen, we have a very small business. I think I can't even tell you the exact number because we've got a couple of things that we just acquired that we have under construction, but I might manage something like 78 units or something like that. And that's a little over 20 properties.
Yeah. So, I mean, that's not small by any stretch of the imagination. That's a pretty substantial real estate portfolio. I think that if an individual investor is looking to build out, that's kudos to you on that.
Thank you.
And part of what you've been able to do is grow that portfolio while also running that successful planning. So what was the real tipping point to get you into real estate where you've looked to focus on this? And then how do you balance those two businesses, because they are different, with different focuses? Like, how do you handle that?
So, when I started buying real estate 20 something years ago, the intention of buying that real estate was just to create guaranteed income in the future, or, perhaps I shouldn't say the word guaranteed, but a consistent income stream in the future. Whether you work on Wall Street or even in my planning firm, there's a component of it that you've got to show up and fulfill commitments every single day that require your time. What I was attracted to about the real estate was, at a point in time, if those properties were paid for, they would give me an income stream that I'd be able to live on. And that's really the premise of why I started buying real estate. I started acquiring those assets without the intention of saying, hey, I wanted to own X amount of dollars in real estate or X amount of units. I just said, okay, let's keep it simple. If my bills are X and I could have rental income of Y, my overhead's covered, and it might make for a good retirement one day. Got it.
Now, but being that you have, like, see, we're a little bit, I think, more fortunate in the fact that, for Eric and I mean, this is what we do all day long, right? So we have ample opportunity to look at different situations or opportunities as they come to us. How do you kind of filter that out, right? Like, you have to be mindful of the time that your financial firm, takes, right? So you cannot dedicate, I can't imagine that you could dedicate the same amount of time to your real estate business as somebody else who's just solely focused on it. Like, how do you filter out the noise to streamline exactly to be able to buy the properties that you do buy?
So I just try to stay really grounded in the fact that, at the end of the day, my financial firm is my main commitment, because I've got a commitment to other people. I've got client obligations. My clients need me. So I just really try to stay grounded in the fact that that's my A focus, and it's always been my A focus. I try to do my best to stay out of the real estate business during normal working hours, and I just try to do things around my regular schedule. I'll never schedule, as an example, I try to be very disciplined with my calendar. And as a result of that, like, I'll never go see a property in the middle of a business day. I'll never deal with construction issues in the middle of a business day. Now, as you know, as entrepreneurs, that sounds good in theory, right? Like a textbook, like, I'll never do this. But then there's things that you do, right? And there's things that you have to do. But if 80% of the time I could stick to my core values of focusing on my financial firm, and build good people around me to be able to support the real estate business and inspire them to be able to make decisions on their own, that's given me the flexibility to be able to scale, grow, and continue to build that business.
One of the things, and you mentioned discipline, and for those of you that don't know Joe, I mean, Joe's probably the most disciplined entrepreneur I know, right? He's very focused, very disciplined, but you have and I think you've identified it very clearly. Like, you have a very specific buy box, right? And we were talking about this yesterday. Like, you also know exactly what you want to buy, right? Like, there is no second guessing. And I say this because, having been on the retail side for many years and dealing with a lot of investors, I mean, all right, how many times have you heard somebody say to me, or I've had an investor or potential investor say to me, like, when you ask them what they're looking for, they say, well, I'm looking for a deal, right? And then you ask them, like, well, define what a deal looks like. And what, Eric, what the number one answer I would get when I ask somebody that question?
A good deal?
Yeah. I'll know it when I see it, right? And when you can't define what a deal is, how do you know what you're looking for? You spend a lot of time just wasted.
Yeah.
But
I think, Frank, that's typically your beginner stage real estate investor, right? And I think you don't get to having 78 units by just looking for a general deal. I mean, at some time you're going to develop or target a specific property, like us, right? Like, we see all different types of deals all the time. We've learned to pass. There's something specific that we look for, which I'm sure Joe has something very specific that he looks for. Are we right on that, Joe?
Yeah. So there's really two verticals that we try to transact on in the real estate business. The first vertical, I guess in both verticals, I always look from the lens of how can we add value to an asset. Okay. So the first vertical that we stick in within that metric is how do I try to acquire an asset for somewhere between 60 to 70% of ARV, where I can acquire that asset, add value to that asset, stabilize and reposition the asset, and then put permanent debt on the asset to recapitalize myself with somewhere between 80 to 100% of my initial investment. So when you say, Joe, what is your ideal structure? That is it. And that's within the confines of residential real estate or commercial real estate, specifically retail or mixed use. Those are the areas where we focus. I'm not looking to buy mobile home communities like you guys do. I'm not looking to buy office buildings because it's not a building. I'm not looking to buy self-storage. I'm not buying industrial properties. My buy box is small, multi-family, mixed use, and small retail strip centers that I can really add value to. And that's an A deal for us. Something we can go in, we can turn over construction really quick. We can stabilize that asset within 6 months. That's a real A buy box for us. The second vertical is, and I've got two pools of capital that we use to allocate towards these deals. So I've got a revolving pool of capital that's constantly rinsing and repeating and buying those small deals. Okay. And the smallest we'll buy is a 2-unit property. I won't buy a single family home and keep that on the balance sheet. The second buy box is more seasoned capital. And when I say seasoned capital, maybe money that we're taking from a refinance, maybe money that we're taking from a 1031 exchange, maybe money that we've accumulated for long-term savings from my other businesses. And those are assets that we're looking to buy that you're not going to buy at 65 or 70 cents on the dollar, but you might be able to buy them at 85 or 90 cents on the dollar, still add value, but it's more of an asset that you want to own for a very long period of time. And you think long-term, you can see some good appreciated value. Those are really the two lanes that we stick in.
But in clearly defining that, right, you not only empower yourself in terms of saving time, but I'm sure you have a team of agents that you've probably developed over the course of the year or the years that know specifically, hey, this is a deal for Joe. Rather than them sending your inbox 100 deals, they're probably sending you only the specific opportunities that will fit into that. So when you're allocating that time and that the time, which is your biggest resource to allocate to investigating that opportunity, you know that, hey, this is something that's going to work inside the parameters of what you're looking for.
There's no doubt. And the other thing that's very helpful is I really know the areas where we transact quite well. So I'm sort of old school in the sense of I like driving by my properties. It's something I would enjoy doing on a Sunday or a Saturday, going to the property, walking into stores, walking around a building, seeing what's going on. I like to be close to the properties. I know how much effort you and Eric put in on almost creating that without being close to your locations, because you're constantly putting time into going down to these areas. I think that's so important. But that also gives me market pulse. I know the areas. If somebody brings me a deal in my backyard, I could short circuit my underwriting of that deal tremendously because I know the ARV down to what side of the town is the building on based on the back of my hand. And then I've got 3 or 4 resources that I can lean on to tell me if it's an area that I'm not 100% on, but I know, okay, here's kind of what you're looking at. So that's been very, very, very helpful. And you're right. By having the relationships of people that are bringing me things inside of my buy box, short circuits how long it takes me to underwrite something. So like for the last 3 days, I've been underwriting a strip center that was brought to me that's like right in the second vertical, right? It's not you're not buying this at 65 or 70 cents on the dollar. But it's kind of really something that I want to own in an area that I'd like to own, that I think I could add value to, that maybe others aren't seeing. So it just allows me the ability to underwrite that in a little bit more of a streamlined process.
So that's an interesting point, because now you're talking about a deal you're looking at now. What do you and you do like these mom and pop strip centers, right? That's something that's you've targeted in a lot. What is it about that deal that you think that you've seen, or where you can add value, where most people are just stepping away from?
So I think the first problem is most people aren't stepping away from. I think the biggest challenge we see, especially in the area in which we live, which is in New Jersey or New York, there's a lot of money that's been parked in different places, and people still are paying top dollar. So the competitive nature, similar to probably your business, is very difficult to buy things at a reasonable multiple. But to answer your question, here's what I like about it. It's an area in Ocean County, New Jersey, that is growing. It's already built up. So we're not waiting for the wave to come. There's a lot of people from up north relocating to this area. It's a very busy area. Although it's in Ocean County, it's a full-time town. So it doesn't shut down in January, February, and March and reopen Memorial Day. So it's a 12-month a year town. The building was built. It's a 15,000 square foot center. It was built in the early 1980s. And you can tell the person who owned it was an absentee or a landlord just happy to have the place rented. The place has not been updated in just about that time. They've done the least amount to keep the building maintainable. And by virtue of that, their tenants show how the building is managed. And I always kind of just look at things very simply. Like if I had an idea for a business, would I put my business in this center? It checks the box of being in a great location. There's a Wawa on the following corner. It's got a great traffic count, so it's a great place you'd want a business. But personally, I would never open a business in a shopping center that looks the way this shopping center looks. So I just keep things real simple. I wouldn't put a business in that shopping center. Now, what would it take for me to put a business in that shopping center? Well, I could change the facade. I could change the parking lot. I could change the landscaping. I could do some value add to give it a different look. And once it has a different look, now you have franchisees, people who are entrepreneurial. That building starts capturing the attention of people that aren't currently looking at it. And as a result, I can go from gross leases to net leases. I can start maybe recapturing the tax revenue. I could have the tenants invest into their spaces because we redo leases and put parameters on those leases that they've got to maintain their stores in a certain way. So those are the things I look for. And I think over time, I could add a decent amount of value to a property like that by increasing the tenants and the facade.
But when you're going into a property like that, do you find some challenges now getting debt, or lining up debt? Because without a corporate tenant, without it's some of those retail shops are not easy to finance, right? Yeah, I would imagine.
Well, when you have a vacant property, yeah, it could definitely be challenging to get traditional financing on a property. Joe does have a track record, right? So I'm sure he's got a system in place for that, right? Where he's probably done this multiple times and maybe has a relationship with a lender that trusts him and understands what he does and sees his vision and allows him to do something different than your first time real estate buyer looking at a property that's vacant. But I mean, the main thing that sticks out for me with Joe is that again, like you said before, Frank, he's just a very disciplined person. And I think if you stick to the same area and the same buy box, you're gonna find those opportunities that, like you said before, Joe, just people are just overlooking the opportunity that you're seeing.
Eric, one of the questions I hear all the time from people is, how do you find these deals? How do you find these deals? And the answer to the question is, I start by looking for them. I'm looking for them every single day. I have people looking for them for me. We've got marketing channels to look for them. When people say, oh, you found some deals, you got lucky. No, we didn't get lucky. We were very intentional, and our intention found those opportunities. What they're not talking about is the deals I look at every single day of my life that we don't buy. We're buying a fraction of those deals. We're looking at deals every day that don't work.
So, so how do you, and this is an issue that I think a lot of investors have, right? How do you, stay away from the shiny box, right? Like, how do you, you've had success in multi, you've had success in retail. How do you keep from that shiny box syndrome where, all right, now I think I'm good here. I know what I'm doing here. I'm going to pivot and do something different. Like, how do you keep yourself grounded, to just stay that path?
I just continue to tell myself and remind myself that I'm not that smart. So I really spend a lot of time just knowing what I know, whether it's in my financial business or my real estate business. I just want to be an expert in the areas that I know. And if I am an expert in those areas, I quickly realize that I'm not an expert in other areas. So I just stay in my lane. And yeah, it could be nice to get into things that you don't know anything about. But they say if history doesn't repeat itself, it oftentimes rhymes. If you look at people who have done that, it more oftentimes than not results in failure.
I think that's one of the things when we looked at when we got into the manufactured housing space and we said, all right, we're going to make a move into, and we first bought our park. I think we slowly realized or quickly realized that if we weren't solely focused in operating a mobile home park, we could easily be chewed up by everything else. And we've seen a lot of sophisticated real estate investors want to get into the manufactured housing space. Like I want to own a mobile home park because I hear that it's, it's consistent cash flow. It's, you have long-term, it's recession resistant. You have tenants that stay for a long time. It's a very stable place to invest money. And then they get into it and they realize, wow, there's a real business inside of it that you have to operate. But I'm focused on new development, or I'm focused on, I'm really a builder, or I'm really a guy that does something else. And all of a sudden the park runs away from them, right? Because they're not able to do the little things that you have to do to operate a community. And we decided that, hey, this was going to be our lane. And then we just, to your point, we stay in our lane, right? We don't look at deals outside or pivot outside of what we do, even if it might be a good deal, right? Like, we started as flipping houses, but I won't buy a house to flip, even if it's a great deal, because it would take me away from what my core principle is, which is we want to build the best mobile home park investing platform out there, right? And
those are the people who wind up being the best at what they do.
That's it. And I think that you have to.
In my financial business, right? Like we come across competitive situations frequently with some of the clients that we work with, that we might be helping them with succession planning or exit planning or doing some real comprehensive estate work. And when they speak to their other advisors who they've got trusted relationships with, because maybe those people are managing their money, those people try to get involved and do some of the things that we're doing. And we explain to the client, like, this is where we specialize. This is our buy box in that business, right? We're not going to try to manage the money the way maybe your advisor is, but they're also not going to be able to provide the value on some of the work that we're doing. That principle is agnostic to industry. It works in every single industry. And when you look at people who are operating at the highest level in any space, they're specialists.
And you hit on something before, and you talk about like the time management of how you've structured your investments. And you've got obviously we've spoken before, but you've got a way where you kind of delegate times and days. Like, I mean, in terms of time blocking, where you're not multitasking from your real estate investment to a client, right? That in your initial practice, like, how do you structure that, or how have you gone about structuring that to be able to be successful in both worlds?
I just really try hard to be present in whatever it is that I'm dealing with relative to business. So when I'm working with clients in my financial firm, I'm in that meeting, meaning I don't have a cell phone. I'm listening to what the person says. They have me. They have my time. They have my expertise. That's what they're there for. That's what I'm there for. We're not there to talk about a strip mall that I'm investing in. That's not important. That's not why they're in my office, right? And quite frankly, we've been fortunate enough that we're so busy throughout the day. I don't have the time to say, let me just take 30 minutes and start playing with this real estate deal. Again, I think it's the 80% rule. Like this morning, I had to go stop at a property, so I just made sure I got there early before the office. And I'm also trying to put an offer in, and I have to sign an LOI on a deal at some point today. So in between meetings, I will take that time and do it. But 80% of my day is focused on what I really need to be focusing on. And those are just the emergency things that are coming up because they've got to be dealt with today.
Got it. How do you structure your real estate investment? This is all you do these deals yourself. So when you're going in, I know Eric alluded to the debt before. Do you have banking relationships? Do you try to get creative in the deal structure? Or what's a typical, deal? Like you're buying the strip mall, how would you structure that? So if somebody was listening and wanted some insight, like how would you go about, allocating the capital, structuring the deal, laying in the debt if you're bringing in any debt to the deal?
Sure. So I'll give you both sides of the spectrum of how I structure deals and the different ways I do that, if you think that would be helpful.
Sure.
So I guess first and foremost, just for full disclosure, everything I own myself. It's my wife helps me with the business. We've got a team. It's our own personal assets. My financial firm has nothing to do with real estate. We don't take on investors' money to buy real estate. We don't partner with clients in real estate. We really keep it completely separate. Okay. With that being said, there's the two verticals that I mentioned to you of how I do deals. The first deal, the deal on the left, meaning the 60 to 70 cents on the dollar deals, I'll buy those one of two ways. I'll either buy them 100% with capital that we have accessible personally from our personal balance sheet. I'll sit on the asset, rehab the asset, and then restructure debt on the asset to recapitalize my personal balance sheet once I've done whatever I needed to do to increase value and stabilize that asset. That's been something we've been doing for a very long time. It's also something that I work with in my financial firm in the sense of that, we've got vehicles and assets that we help clients with to accumulate assets in a very efficient manner through life insurance policies where we've got guaranteed access to capital through the policies that we have. And then we lever off of those policies to acquire other assets, essentially creating our own liquidity buffer. Okay. The second way I'll do it within that same vertical is by levering that even further. And this is just something I've built relationships with as of recent. So there's certain financial institutions out there now, they're sort of like hedge funds where they'll do different types of loans where you can come to the table with 10 or 20% of the purchase price. And because of my history, they'll pre-approve me for 100% of the construction costs on an interest-only loan. It's not hard money because it's based on a hedge fund. It's kind of hard money where it's an accelerated rate, but we know our numbers and it's for a period of time. So that just gives us the ability to potentially scale even larger and do more deals, presuming those deals are available. And we've toyed with that. So we'll put up 10 or 20% of the purchase price. We'll get 80 to 90% financing on that, 100% of the construction, and then we'll take that debt out with traditional, conventional, long-term financing once that deal is stabilized within 6 months. So those are all the 65 to 70% ARV deals that we're going to reposition and hold on the balance sheet. The other vertical, the sort of larger deals or a little bit more stable assets that we're just going to force appreciation, they happen a variation of ways. We've built some banking relationships. I found that community lenders have worked better with us and we've got some good relationships with them. They know us, they understand us, they get us. And we've done a variation of deals, whereas in some, we'll just come to the table with 30 or 35% as a down payment, presuming it can cash flow. Commercial deals will typically amortize over a 25-year period. And depending on the DSCR calculations that those banks use, we know the metrics of those numbers, and I'll use those spreadsheets to underwrite my deals, which eliminates the bank saying, here's how much we'll give you. We kind of know going in based on the cash flow and how the banks underwrite them with their holdbacks and their management fees and their vacancy rates of what we'll be able to get on that asset. On a traditional deal, we'll buy, hold it, and then just try to self-liquidate that over a 15-year time period. So we might prepay the mortgage, try to accelerate the payments on that and increase value of the rents over time and increase cash flow. I don't run my real estate business for cash flow. meaning today. I run it for cash flow tomorrow. And one of the big metrics that we look at is how we're accumulating equity, which keeps our LTVs very, very consistent, and we're not over levering ourselves. Another way that I'd consider doing loan deals in that space is we have some banking relationships where if there's a heavy value add component, they'll do something with us where they might lend us 70% of the purchase price and then give us a construction buffer. So maybe they'll give us a $200,000 or $300,000 line of credit, right? So they'll give us 70% of the ARV up front and split it into two tranches of purchase price loan, construction. The construction has a draw schedule, and once the construction draws are complete and the asset's stabilized, they'll blend the two loans together and amortize it over a traditional loan. And that might look something like this. The entire loan's interest only for the first 12 to 18 months. And then after 18 months, it goes into a 25-year amortization schedule. So they give you the time to maintain your capital and your cash flow as you're stabilizing the asset.
Got it. Okay.
All good stuff.
Good.
All good stuff, Joe.
So Joe, I mean, obviously you've been very successful. You've been doing this for a while. I mean, what's a shining mistake that maybe you made early on that kind of, no one's 100% perfect, and I could probably tell you a million mistakes I've made along the way, but what's something that kind of resonated with you early on? So if anybody out there is listening, like this was something I realized was an error, and where we had a course correction from there. So,
I mean, listen, to your point, I've made a ton of mistakes, right? Some of the things that stand out to me is, there's a constant, I guess, conflict of like landlord tenant, right? Like the landlord's the big bad wolf and the tenant's being taken advantage of. And I do think a lot of landlords take the position, and property owners take the position of, how do I get the most out of this? And they eliminate the human element of the other person. I think that if you're going to be in the property management business, which is the business we're all in once we decide to own real estate, I think there's value in actually being a really good property owner and landlord, and really trying to run your properties as a business, but doing it by doing the right thing with the tenants who rent from you. And that's really through creating good property management structures, being attentive to issues that clients have, making sure that you dispatch people to service their requests as soon as possible. And it's really it's a win-win, because your buildings over time become better managed, right? Meaning they're in better shape because you don't put Band-Aids on things, and you're really fixing things. And you wind up with a longer term tenure of tenants. So I think the number one thing is there's no shortcuts in the tenants. I think if you could really try to structure being a good landlord, it'll help you scale your business, and you're not worrying about taking the shortcuts. And then I think the other thing is just shortcuts in general, right? Like 25 years ago, I'd buy a one-family house and make it a two-family house. Like we would never do that anymore. Like there's no illegal rentals. There's no, there's an extra bathroom and kitchen, so I guess we can rent this out. Those are shortcuts that, quite frankly, there's too much risk associated with it. And you probably have the same thing in your business, right? Maybe there's an extra lot. You could find a way to throw something on that you're not supposed to. We prefer to stay away from those type of ways of doing business and just try to take the higher road. And it's allowed us to be able to grow.
Yeah, I think that whenever you try to take a shortcut, like it never works out. Like there's no shortcut to being successful. There's no shortcut to running a property right. And you're running such a fine line. Like there's only one way to really, the right way. There's one way to do it, and it's the right way, right? And that just creates long-term success, wealth, and stability.
That's the key thing there, Frank. There's no long-term shortcuts, right? You may benefit from a shortcut in the short term, but eventually, like Joe said, I mean, when there's risk there, eventually it'll come back to you.
Yeah.
So,
our approach is we have a very long-term way of buying real estate. I'm not a syndicator, as I mentioned earlier. I don't look to buy assets and get out of them in 3 years. I don't have a short-term window. I really have a long-term window, and I believe real estate, no different than some of the strategies that we implement for our clients on the financial side. A lot of the work that I focus on is get rich slow, but time goes fast, right?
Mhm.
So if you do the right thing and you run a good business and you just continue to do the right thing and grind, I don't have to worry about where these assets are going to be in 5 years. I don't have to worry about where they're going to be in 3 years. I'm not buying them for that reason. I know that strip center that I'm looking at 15 to 20 years from now, that area is going to be busier. It's going to be more expensive. There's going to be more people. And if I run the business the right way, I'm going to be the beneficiary of the appreciation of that asset.
Sure. I mean, and that's one of the advantages of real estate. It's not about get rich quick. It's about build wealth slowly. And just I remember one of the sayings that stuck with me from my Wall Street days, right? Because in the 90s, I was working on Wall Street. It was not that I want to date myself, but no one trade will make you, but one trade could break you, right?
Yeah.
So when you have that mentality that's just drilled into you, you're not looking at a deviation or a shortcut to wherever your goal is looking to be. So in any like one last tip that you would give somebody who, let's take in your position, who has a business that they're looking to build a real estate investment portfolio alongside of that, like what would be your number one tip that you would give somebody who's looking to get where you are currently?
I think in anything you're going to do in life, whether it's health and fitness, personal growth and development, business, um, unless you're in the technology business, everything we do has already been done. And most of it's been done at a very high level to the tune of what you're looking to accomplish. So I think if it's something that you're looking to do, I'd seek out mentors. I would seek out people who've been successful in doing the things that they've done. And I've tried to educate yourself through the mistakes of others. And once you have that knowledge, take action. So I think the biggest thing is people try to do things on their own and they continue to wait until they have everything figured out. And I think the longer you wait to figure things out, what winds up happening is time passes you by. I think the most important thing is to learn, but take action. And through that action, you will make mistakes, but you'll learn from those mistakes and you'll get better like we all have. And if you fast forward 10, 15, 20, 30 years, those mistakes have really formulated into the success that we've had in our businesses. And we just keep learning every single day, and we're going to keep making mistakes, but we'll get better from those mistakes and we'll grow and we'll continue that cycle.
Great stuff. What's your big takeaway from today?
My big takeaway is, you got to find a system that works for you, right? Everybody has a different career path. Everybody has different, flexibility with their schedule. Everyone has different goals, a different vision. I definitely think that if you have never invested in real estate, finding a mentor is key, right? Someone that you could go to and you could talk to, and you could ask them questions along the way. You're always going to make mistakes, but having a mentor is key. And just find the system that works for you and your schedule, and learn and slowly grow with that.
Yeah, I think having a mentor is, I mean, you hit the nail on the head. I think if you have a mentor, it just speeds your pace of learning. I think you have to be focused in terms of what you need or what you're looking for. And by having that clarity, you can share that with everybody else in your team or as you build out your network to help you along that path. And then the discipline to follow that, right? Not to deviate off of that path because you think something is quicker or shorter, or you're going to just allocate that time, that you're going to have and keep everything in that box. So, I think we got a lot of great nuggets from this. Joe, I want to thank you for being part of this program. And if anybody wants to reach out to you or has questions, like where could people reach out to you or contact you?
Sure. So you can always reach us through our financial website, which is BiondFinancial. That's BIOND financial.com. And then our email is Joe, or my email is joe@beyondfinancial.com. So best way to get us, go to the website, call the office if you'd like to talk, send us an email, and my team can set up a time.
Great. Thanks for being part of the program. This program has been brought to you by the mhpexchange.com. So if you liked this program, rate it on iTunes or Spotify, share it with your friends, and bookmark it. And if you're looking to build a real estate portfolio or business and you have questions, feel free to reach out to us. If you have a deal in the MHP space or question about it, feel free to reach out to us at the MHP Exchange. Until next time, everybody, happy investing.